In our last explainer, we learned exactly how to find sleeping giant companies using the giant screen. But today I need to warn you about the single most expensive mistake I see value investors make over and over again. They do the work, right? They find a perfectly analyzed company, return on equity above 15, a price-to-earnings ratio of just 4, price-to-book of 0.4, and a massive dividend yield of 6%. They're incredibly excited. They hit buy, they lock it in, and then the stock drops another 30% over the next 12 months. It causes just massive frustration and brutal financial loss. So what happened? Was the company wrong? No. Was the fundamental analysis wrong? Absolutely not. The timing was wrong. And timing, knowing exactly when to hit that buy button, is exactly what technical analysis gives you. Welcome to part 2 of this explainer.
In today's explainer, how to read stock charts, 3 essential indicators for the perfect entry, and the percent optimism strategy, which is literally the most powerful market timing tool available to individual investors. Ready? Let's go.
Section 1. The Toolkit. Market Trends and Averages. Okay, let's dive into this and look at the very first tools you need to avoid catching a falling knife. You see, stock prices don't just move randomly. They move in very clear, specific trends. An uptrend is the bull's domain, right? You can spot it by looking for higher highs and higher lows on the chart. When you see this, it's generally safe to buy the dips. Every pullback toward a previous high is an opportunity. But a downtrend, that's lower highs and lower lows. Buying into a downtrend is exactly like catching a falling knife with your bare hands. It's incredibly dangerous. You absolutely must wait for confirmation that the trend is reversing before you even think about entering. Next up is the moving average. Now this calculates the average closing price over a specific number of days, creating a nice, smoothed out line right over the chart. For long-term value investors, we're specifically looking at the 50-day or the 200-day lines. That 200-day moving average, that acts as a visual anchor. Think of it as a true value line. If the price dips significantly below this line, the stock is historically undervalued. If it shoots way above it, things are getting historically expensive. And check this out. This brilliantly illustrates what happens when these two moving averages interact with one another. We've got the golden cross versus the death cross. The golden cross happens when the fast 50-day moving average crosses above the slow 200-day moving average. That is a highly bullish signal. But the death cross, when the 50-day crosses below the 200-day, well, that's an ominous bearish warning. In fact, a death cross appeared as a massive warning sign late in 2007, just months before the absolute worst of the 2008 financial crisis. Those who paid attention protected their capital, and those who ignored it faced massive, massive losses. Section 2. The Toolkit. Momentum and the Lie Detector. Let's pivot to the next set of tools that help us gauge momentum and validate whether a price move is actually genuine. First up is the stochastic oscillator. Don't let the fancy name intimidate you. It's simply a momentum gauge that oscillates on a mathematical scale from 0 to 100, showing you exactly where the current price sits within its recent historical range. A 0 means we're at the absolute bottom of that recent range, and 100 means we're at the very peak. It is incredibly useful for spotting extremes in buying or selling pressure. Here's exactly how you read it in practice. Dropping below 20 puts you in the oversold zone. This means the stock has been falling hard and fast. Selling pressure is at an absolute extreme. It alerts you to a potential buy signal, specifically once the fast line crosses over the slow line. Conversely, rising above 80 puts you in the overbought zone. This signals peak greed and buyer exhaustion. When you see the lines cross above 80, that is your cue to stop hoping for more and start locking in your profits.
But how do you know if the move on the chart is actually real and not just a fake out? Well, that brings us to volume, which is literally the market's ultimate lie detector. Volume represents real money voting. A genuine breakout is always accompanied by high volume. That's institutional, smart money stepping in. On the other hand, a fake breakout happens on low volume. That's usually just small traders pushing the price up artificially, and it almost always reverses. The golden rule here: never trust a price move that isn't backed by strong volume.
Section 3. The Master Framework. The Percent Optimism Strategy. Let's zoom out and look at the big picture. So how do we tie all these micro indicators together? Enter Dr. T's master tool, the Percent Optimism Level. It measures where the current price sits within its long-term compound annual growth rate, or CAGR, band tracked on a scale from 0 to 100%. This strategy essentially steps back from the daily noise of the charts to ask the big question: where are we in the macro cycle? Think of it like a massive pendulum, constantly swinging back and forth between extreme fear and extreme greed. Now, what's really interesting about this slide is this specific number right here, 25%. An optimism level below 25% represents maximum fear in the market. The news is catastrophic, everyone is panicking, and prices have completely crashed. But for you, the smart, informed investor, this is the absolute best time to buy. This is the exact moment where generational wealth is built. On the flip side, we have 75%. When optimism crosses above 75%, it signals maximum greed and euphoria. Stocks are sitting at all-time highs, the TV is constantly talking about the roaring bull market, and your neighbor is bragging about their crazy gains. Because the downside risk is now incredibly severe, this is the critical moment to start selling and taking your money off the table. We can easily map these percentages into what we call the 4 market seasons. Look at the exact investor action required for each phase here. Winter, from 0 to 25% optimism, is maximum fear, so you buy aggressively. Spring, from 25 to 50%, is cautious recovery. You hold or buy selectively. Autumn, from 50 to 75%, growth slows down. You hold or start taking profits. And summer, from 75 to 100%, is maximum greed. You sell. It's a beautifully structured, logical map for navigating the entire market cycle without ever letting your emotions get in the way. Section 4. The perfect entry. Putting it all together. So, the crucial point is figuring out how to synthesize all of this into one bulletproof action plan. Here is your step-by-step master plan for the perfect entry. Step 1. Your fundamental screen confirms you've found a great, high-value company, the sleeping giant we talked about earlier. Step 2. The percent optimism strategy confirms the broad market is in the winter season, meaning you are buying alongside macro-level fear. Step 3. A stochastic crossover below 20 on the daily chart confirms your exact entry timing. Grouping fundamental analysis, macro technicals, and micro timing together like this creates an incredibly high-confidence trade. As the legendary Warren Buffett says, be fearful when others are greedy. Be greedy when others are fearful. Now, this isn't just an inspiring, folksy quote to put on a mug. As we've just seen, it perfectly encapsulates the exact mathematical reality of the percent optimism strategy. When optimism hits 100, others are exceptionally greedy. You need to be fearful. When optimism drops near 0, the masses are absolutely terrified, and that is your time to be greedy.
And that brings us to a critical final thought for you today. I really want you to look closely at your own portfolio right now. Which season are you currently buying in? Are you buying into the euphoric summer where risk is highest, or the fearful winter where upside is greatest? Use these tools. Verify the volume, check your moving averages, and calculate that optimism level before you accidentally catch another falling knife. Thanks so much for joining me on this explainer, and I will see you next time.